A liquidation preference is a common feature in preferred stock issued by a company in a fundraising round. The liquidation preference kicks in when there's what's called a deemed liquidation event. So, for example, the company is sold or it shuts down and decides to dissolve. The liquidation preference entitles those investors to be paid first. And so the amount that an investor may receive will depend on how much proceeds come from that deemed liquidation event. For example, if the proceeds from the liquidation event are less than or equal to that liquidation preference, the investors are going to get all the proceeds from that deemed liquidation event, and the founders are going to receive nothing. In the case where the deemed liquidation proceeds exceed the liquidation preference, but not by enough to cause the investors to convert to common, then the investors are going to receive up to the liquidation preference, and then the rest is going to go to the founders or be split amongst the investors and the founders. And then in the third scenario, when the deemed liquidation event proceeds far exceed the liquidation preference, then it's going to be likely that the investors convert to common, and then everybody receives their pro rata share of the proceeds. And this is obviously the best case scenario.